In the roaring crypto bull market of 2021, a new kind of financial institution emerged with a revolutionary promise. Give us your crypto, and we will give you up to 20% interest, completely risk-free. Companies like Celsius Network and Voyager Digital didn't pitch themselves as reckless crypto casinos. They marketed themselves as the safer, smarter alternatives to traditional banks, famously telling millions of everyday people to unbank themselves. For a while, it worked flawlessly. Millions of retail investors poured their life savings, college funds, and retirement accounts into these platforms, watching their wealth grow on beautifully designed apps that made generating massive yield look as easy as pushing a button. But behind the slick marketing and the charismatic CEOs was a terrifying reality. The yield wasn't magic, and it certainly wasn't safe. This is the story of how the biggest crypto lenders built a house of cards on the illusion of safe yield, how a hidden web of reckless gambling brought the entire system down, and why the oldest rule in finance, if it sounds too good to be true, it is, ultimately cost regular people billions of dollars. To understand how things went so wrong, you first have to understand the pitch that made Celsius and Voyager so incredibly popular. In the traditional banking system, if you put your money in a savings account, you might earn 0.5% in interest, while the bank lends your money out at much higher rates and keeps the profit for themselves. Celsius CEO Alex Mashinsky claimed he was going to flip that model upside down. He promised that Celsius would lend out user deposits to massive, over-collateralized institutional borrowers, take a tiny cut to keep the lights on, and pass 80% of the profits directly back to the users. It sounded like the perfect democratization of finance. Users were earning 10, 12, or even 18% annual percentage yields on their crypto and stablecoins, simply by holding them in an app. Voyager Digital offered a similar model, operating as a publicly traded company in Canada, which gave retail investors a false sense of regulatory security. They believed that because Voyager was audited and publicly listed, their funds were protected by the same rules that govern traditional stockbrokers. But there was a fatal flaw in this entire ecosystem. In a market where interest rates were essentially zero, there was no legitimate, risk-free way to generate 20% returns. The only way to pay those massive yields to millions of users was to take their deposits and engage in increasingly dangerous, high-risk speculation behind closed doors. As more and more users flocked to Celsius and Voyager, the companies faced a massive problem. They had billions of dollars in deposits, and they had to generate enough profit every single week to pay out those double-digit interest rates. To do this, they stopped acting like safe, conservative lenders and started acting like degenerate hedge funds. Celsius took user funds and pumped them into highly experimental decentralized finance protocols. They locked up hundreds of millions of dollars in illiquid assets, like staked Ethereum, which couldn't be easily sold if users suddenly wanted their money back. Voyager took an even simpler but equally disastrous route. They took roughly $670 million of their customers' money and handed it over as an unsecured loan to a single entity, a crypto hedge fund called Three Arrows Capital. Unsecured meant that Three Arrows Capital didn't have to put up any collateral. Voyager essentially handed over $500 million based on a handshake and a promise, all to chase the high yields they needed to keep their retail customers happy. For a time, the bull market hid all of these sins. As long as the price of Bitcoin and Ethereum kept going up, the hedge funds made money, the lenders made money, and the retail users got their weekly interest payouts. But the entire system was a giant interconnected web of leverage, just waiting for a single spark to burn it all down. Let's take a quick break to thank our sponsor, who makes these deep dives into financial history possible. If the collapse of crypto lenders teaches us anything, it's that blindly trusting a platform with your assets can lead to disaster if you don't have transparency and control over your own trades. That's why you should check out The Alchemist, an intelligent, automated trading tool designed to navigate the volatility of the modern market by using advanced algorithms to find and execute trades 24/7. Unlike the opaque black box lending platforms of the past, The Alchemist is built for speed and complete transparency, giving you a way to grow your wealth while maintaining visibility over exactly what your money is doing. Click the link in the description and use our code CRYPTOLENDERS10 for a special discount to see how a smarter, more transparent approach to automated trading can help you build a more secure future today. Now, back to the collapse of the crypto lending empire. The crisis was triggered in May 2022 when the Terra Luna crypto project and its digital currency UST suddenly collapsed, wiping out tens of billions of dollars almost overnight. When Terra wiped out $40 billion of wealth in a matter of days, it sent a shockwave of panic through the entire crypto industry. The hedge funds that had borrowed money from Celsius and Voyager, especially Three Arrows Capital, were heavily exposed to Terra and suffered catastrophic losses. Suddenly, Three Arrows Capital was bankrupt, meaning that the $670 million Voyager had lent them was simply gone. At the same time, retail users began to panic. Seeing the market crash, hundreds of thousands of Celsius users logged into their apps and hit the withdraw button, wanting to get their funds out before things got worse. But Celsius didn't have the money, because they had locked user funds in illiquid DeFi protocols and lost millions in bad trades. They were facing a classic bank run, but without the protections of a traditional bank. On the evening of June 12, 2022, Celsius sent out an email that made the crypto world's blood run cold. Citing extreme market conditions, they announced they were pausing all withdrawals, swaps, and transfers between accounts. Millions of users were suddenly locked out of their life savings. Just weeks later, Voyager followed suit, freezing their platform as well. The promise of unbanking yourself had officially turned into a nightmare. The aftermath of the freezes was a brutal reality check for retail investors who had believed the marketing hype. When Celsius and Voyager officially filed for Chapter 11 bankruptcy in July 2022, the court documents revealed the ugly truth. Users discovered that according to the terms of service they had blindly accepted, the crypto they deposited didn't actually belong to them anymore. It belonged to the companies. Everyday people were reclassified as unsecured creditors, placing them at the very back of the line to get their money back, behind the massive lawyers and institutional players who were picking over the remaining scraps of the companies. Even worse, blockchain data and internal leaks revealed that while retail users were being told everything was fine, top executives at Celsius, including CEO Alex Mashinsky, had quietly withdrawn tens of millions of dollars of their own funds just weeks before freezing the platform for everyone else. The companies that had promised transparency and financial freedom were exposed as massive, mismanaged black holes of debt. The contagion spread, taking down other lenders like BlockFi, and severely weakening the balance sheets of massive exchanges like FTX, setting the stage for even bigger collapses later that year. The fall of Celsius and Voyager is a tragic chapter in financial history, but it is also a timeless lesson about human psychology and the allure of easy money. These platforms didn't succeed because they invented a new kind of math. They succeeded because they weaponized trust. They used the aesthetics of modern tech companies and the language of financial rebellion to convince ordinary people that risk had somehow been eliminated. It proved that no matter how advanced the technology gets, the fundamental laws of finance never change. Yield is simply a measurement of risk. If someone is offering you returns that vastly outperform the market, they are taking massive risks with your money to get it. The collapse of the crypto lenders destroyed the illusion of safe yield forever, leaving behind a stark reminder for the next generation of investors. If a financial product sounds too good to be true, you aren't the one making the profit, you are the product. Thanks for watching. If you want to stay ahead of the next big shift in the financial world, make sure to like this video and subscribe to the channel for more deep dives into the stories that are reshaping our economy.